Welcome back to John Orther's Note. A Robin Hood tax, a tax on the activities of bankers, is the dream of all those who think the financial sector should be paying more towards public finances and that the financial system should somehow be slowed down. But the European Union's plans for a financial transaction tax have run into all sorts of problems, as the Financial Times has reported this week. With me to discuss where we are is Philip Stafford, who's the editor of FT Trading Room. Philip, this idea of taxing financial transactions has been around for an awful long time, hasn't it?
It is. I mean, it's not new. The current incarnation, its guiding light is a US economist called James Tobin, who first came up with the idea around 40 years ago. Although it does have a longer history. John Maynard Keynes back in the 20s, to be honest.
And what was his basic idea?
Well, really, for Tobin, it was a tax on foreign currency to try and slow down the markets, to throw a bit of sand in the wheels, as he described it.
The idea presumably that slower financial markets mean better markets, safer.
Yes, he was speaking at a time when currencies were beginning to float. Fixed exchange rates had come to an end, and there was an awful lot of volatility on the markets. So you can see where the parallels are with the modern day phenomenon. And
as we know, of course, financial market activities expanded enormously. We brought one chart along here showing this is just equities.
Indeed,
in the last 10 years.
Indeed. I mean, and you can see here why it's so tempting to your average policymaker, taxman. The derivatives markets globally are quite similar to that. As you can see, it has been quite a run out.
Yes, it's come down, of course, since the crisis. Less activity globally, but still much higher.
It has, but I mean, as you well know, trying to actually turn theory and taking that big pie there and making it into practice is a bit difficult, isn't it?
Absolutely. Well, there's a lot of resistance, of course, from the banks who don't want to be taxed. But there's also practical problems, aren't there? I mean, what would you think would be the biggest practical problems that we're running into?
Well, there are all sorts of issues around collecting it. First of all, there isn't really a central place in Europe for settlement where it can easily be collected, as there may be in the UK, for example.
Oh, the stamp duty we have.
Yes, indeed. Other issues, you're relying on some countries that maybe don't have a great history of tax collecting in the first place.
I mean, the big problem, of course, is that actually distinguishing between good financial market activity and bad and speculative, and no one really agrees how you can define the difference, and let alone try and tax the bad bit but not the good bit. I mean, some crucial market functions would be affected by the FTT.
Absolutely. That is particularly the case in derivatives. We have
which are used for hedging and normal activities.
Yes, I mean, but they're also equally used for speculation as well.
Yeah.
But the two are interlinked. Trying to find out which one is.
Yes, and then what we hear from bankers are particularly worried about the repo market, which is it's a slightly technical market, but it's about providing everyday liquidity to markets, but thousands of transactions every day.
Well, exactly, and as you well know, there has been an awful lot of pushback on that, not just from people who are maybe you expect them to complain, but they do have some justified grievances, don't they? And
I think there's also a lot of dispute between the individual governments. There's only 11 Eurozone governments that are going to go ahead with this, and they can't agree on.
Well, that's again Tobin's idea was that everybody agreed to it.
Let's just look at the example of Italy, which has introduced a tax on financial transactions. This is showing the volume of business that's over the counter, that's not going through exchanges as a share of the total. You do see a bit of a decline.
We brought this one up because the Italian example, which started in early March, it was really it also involves the derivatives market, which previous ones haven't done so. And this is for the over-the-counter market. As you can see, it wasn't entirely uncommon for quite 20-30% of the market to go over the counter. That's where it comes in roughly, and you can see here what a difference it's made.
Philip, thank you very much. So the financial transactions tax has had some impact in Italy. Whether it's the desired effect and whether it would work on a European level, that's another question.